Three things just happened in the silver market within the last 48 hours. Individually, each event might seem technical. A policy comment here. A futures positioning shift there. A subtle signal from miners that most investors completely ignored. But when you connect them together, something very different begins to emerge. First, central bank policy expectations shifted again. Inflation data came in hotter than expected, forcing markets to reassess how quickly interest rates can fall. Bond yields moved. Currency markets reacted. And historically, moments like this create instability in real interest rate expectations, one of the most powerful drivers of precious metals demand. Second, institutional positioning in silver derivatives quietly surged. Call option activity increased sharply in higher strike levels, particularly in contracts that only start paying off if silver moves dramatically higher. These are not the types of trades retail investors typically place. These are positioning strategies often used by funds anticipating volatility expansions. Third, something unusual appeared in the physical market. Dealer inventories began tightening while premiums in certain international hubs widened slightly compared to futures prices. On the surface, it's subtle. But historically, this kind of divergence tends to appear during early stages of structural price moves, long before the broader market notices. And here's the important part. Most financial media is reporting these developments separately. A headline about inflation here. A story about commodities there. A brief note on options activity somewhere else. But almost no one is connecting them. And when you connect them, the picture changes dramatically. Because silver is not just another commodity. It sits at the intersection of monetary policy, industrial demand, and financial derivatives leverage. That means when multiple pressures start aligning at the same time, price movements can accelerate far faster than traditional models predict. By the end of this video, you'll understand why several signals inside the silver market are beginning to line up in a way that historically precedes large price expansions. Not because of hype, not because of internet speculation, but because of the underlying structure of the market itself. We're going to walk through policy decisions, minor earnings signals, physical demand evidence, and the derivatives positioning that could amplify any move that begins. And when you see how these pieces connect, the possibility of silver moving toward levels like $100 or even $150 stops looking like a sensational prediction. It starts looking like a structural setup. Let me show you why. Policy, government action. Everything in the silver market ultimately begins with policy. Because silver behaves partly like an industrial metal, and partly like a monetary asset. And the bridge between those two worlds is central bank policy. Over the past several months, markets have been attempting to answer one critical question. How quickly will interest rates fall? When inflation first began cooling, investors expected aggressive rate cuts. The assumption was that the inflation cycle had peaked and monetary tightening would soon reverse. But the latest inflation and producer price data complicated that narrative. Instead of a clean decline, inflation has shown persistence in several key sectors, particularly services and energy. That forced policymakers to adjust their tone. Instead of promising imminent rate cuts, they began emphasizing data dependency. This subtle shift matters more than many people realize. Because precious metals do not simply respond to interest rates themselves. They respond to real interest rates, the difference between nominal rates and inflation expectations. When inflation remains elevated while policy stays restrictive, uncertainty about real rates grows. Investors begin looking for assets that hold purchasing power regardless of policy outcomes. Historically, that environment benefits gold first. Silver follows shortly after. But silver often moves more violently because it combines monetary demand with industrial consumption. Now add fiscal policy into the equation. Governments around the world continue running historically large deficits. Defense spending is increasing in multiple regions. Energy transition programs require enormous quantities of conductive metals. And silver happens to be one of the most important conductive metals used in electronics, solar infrastructure, and emerging technologies. In other words, policy is simultaneously doing two things. It's sustaining monetary uncertainty, and it's supporting industrial demand for the metal itself. That combination is rare. But when it occurs, silver markets tend to tighten. And tightening markets rarely stay quiet for long. Corporate earnings, minus signal. Now let's move to the second signal: mining company earnings. Mining companies provide one of the earliest indicators of what is actually happening inside the metal market. Why? Because miners sell physical metal. Their realized selling prices reveal information that futures markets sometimes mask. During the latest earnings reports, several silver-focused miners reported realized prices that were slightly above benchmark averages during certain quarters. At first glance, that might not sound significant, but there are two possible explanations. The first explanation is simple contract timing. Mining companies often sell production using forward agreements. If they locked in higher prices earlier in the year, their realized prices could exceed spot benchmarks temporarily. That explanation is plausible. However, there is a second explanation that analysts often overlook: direct offtake agreements. In tight physical markets, industrial buyers sometimes secure long-term supply contracts directly with miners. These agreements can include pricing structures that differ from exchange benchmarks, particularly when reliability of supply becomes valuable. If industrial users anticipate supply constraints, they sometimes pay premiums for guaranteed deliveries. So which explanation is more likely? The answer probably lies somewhere in between. But several indicators suggest that industrial buyers have been increasing long-term procurement agreements. Solar manufacturing demand continues rising globally. Electronics manufacturing remains resilient, and defense-related electronics production is expanding in several countries. All of those sectors rely heavily on silver, which means miners may be seeing something before the broader market does. Not necessarily a shortage, but a tightening supply pipeline. Physical market evidence. The third signal comes from the physical market itself. This is where early structural shifts tend to appear. In recent weeks, several bullion dealers have reported increased demand for physical silver products, particularly coins and smaller bars. At the same time, certain wholesale distributors noted intermittent shipping delays for specific products. Now, it's important not to exaggerate these signals. Dealer shortages do not necessarily indicate global supply shortages. Retail products require fabrication capacity, which can temporarily bottleneck. However, what matters is trend consistency. When retail demand strengthens simultaneously with industrial procurement and institutional positioning, it suggests broad participation across multiple market layers. Another indicator comes from international price divergence. Silver trades globally, but regional demand can create pricing differences. When physical demand increases in one region faster than supply can respond, local premiums widen relative to futures benchmarks. Recent data from several international trading hubs shows small but noticeable premium expansions. Again, not extreme, but historically, these divergences tend to precede larger market adjustments, because futures markets eventually have to reconcile with physical demand realities. And when that reconciliation occurs, price volatility often increases. Derivatives, futures, options pressure. The fourth signal, and arguably the most misunderstood, sits inside the derivatives market. Silver futures trading volumes dwarf the amount of physical metal available for immediate delivery. This is not unusual. Futures markets exist primarily for hedging and price discovery, but leverage inside these markets can amplify price movements dramatically. One key metric analysts monitor is the relationship between open interest and registered inventory. Open interest represents the total number of outstanding futures contracts. Registered inventory represents metal that is specifically available for delivery against those contracts. Typically, open interest exceeds registered inventory by a large margin because most contracts settle financially rather than through delivery. However, when open interest grows rapidly while registered inventories remain stable or decline, the leverage ratio expands. That does not automatically create a squeeze, but it increases sensitivity. Now add options positioning. In recent weeks, higher strike call options have seen increased activity. These contracts only become profitable if silver prices move substantially higher. Why would traders buy these? One possibility is speculative optimism. Another possibility is volatility hedging. But when market makers sell these options, they often hedge their risk by purchasing futures contracts. If silver prices begin rising, those hedges expand. Market makers must buy additional futures to remain neutral. This process is called gamma hedging, and it can accelerate price movements rapidly once key price levels break. Again, none of this guarantees a massive rally, but it creates structural conditions where rallies can move faster than expected. Connecting the threads. Now step back and connect these signals. Policy uncertainty is sustaining demand for monetary hedges. Industrial demand for silver continues expanding through energy transition and electronics manufacturing. Mining companies are hinting at tighter procurement conditions. Physical market signals show small but consistent demand increases. And derivatives positioning suggests that if prices begin moving upward, leverage could amplify that move. Each signal individually might seem modest, but markets rarely move because of a single catalyst. Large price movements typically occur when multiple forces align simultaneously. That alignment is what makes the current silver setup so interesting. It's not about a sudden shortage. It's not about a conspiracy. It's about structure. When policy pressure, industrial demand, and financial leverage begin interacting at the same time, price discovery can shift quickly. And that's why some analysts believe the long-term ceiling for silver could be significantly higher than current levels. Not tomorrow, not necessarily next month, but over the next cycle. Let's step back and summarize the 4 signals we just examined. First, policy conditions are creating persistent uncertainty around real interest rates. Inflation remains uneven, rate cuts are delayed, and fiscal spending continues expanding. That environment historically strengthens demand for hard assets. Second, mining companies are quietly revealing information through their earnings data. Realized selling prices and procurement agreements suggest industrial buyers may already be securing supply more aggressively than the market realizes. Third, physical market indicators, from dealer demand to regional premium divergences, show small but consistent tightening signals. None of them individually prove a shortage, but together they suggest demand is broadening across multiple layers of the market. And fourth, derivatives positioning has created a structure where price movements could accelerate once certain levels break. Futures leverage, open interest expansion, and options gamma hedging all increase the potential for volatility. Individually, none of these signals guarantee that silver will reach $150. Markets rarely move in straight lines. Economic slowdowns could reduce industrial demand. Central banks could successfully stabilize inflation faster than expected. Financial markets could shift capital into other assets if global liquidity tightens. Those are real risks, and anyone analyzing commodities seriously must acknowledge them. But what makes the current situation interesting is how many independent signals are beginning to align at the same time. Policy pressure, industrial demand, physical market tightening, and financial leverage. When those 4 forces converge, silver tends to behave differently than most commodities. It becomes a hybrid asset, part industrial metal, part monetary hedge, and part financial instrument. That combination is why silver historically experiences long periods of quiet trading, followed by sudden expansions that surprise almost everyone. So the real question isn't simply whether silver will reach $150. The more important question is whether the structural forces we discussed today continue strengthening over the next 6 to 24 months. If they do, the range of possible outcomes for silver prices becomes much wider than most investors currently expect. And that's why paying attention to these early signals matters. Not because they guarantee a specific price target, but because they reveal how the underlying structure of the market is evolving. And in markets, structure always matters more than headlines. The investors who recognize structural shifts early tend to have the greatest advantage. Everyone else usually notices after the move has already begun.